We're joined now by Daniel Lacalle, Trustee Chief Economist. He's also the author of Escape from the Central Bank Trap. Well, it's a good one to start on because Turkey is in a central bank trap right now, but maybe not the traditional kind. Daniel, what happens with Turkey, the Turkish lira and that economy, which, as we heard earlier, is so important even geostrategically from a NATO point of view?
Absolutely. Well, thank you very much. I think that the key thing about what's happening in Turkey is that the country has been ignoring the rising imbalances, not only a trade deficit, but a fiscal deficit. And the central bank continued to increase money supply dramatically in the hope that a weak dollar and low interest rates would continue to flood the Turkish economy with cheap dollars, with foreign investment, with more money coming from outside countries. And what happened is what in the book I call the sudden stop, which is that all those imbalances continue to grow, and then what happens is that suddenly it changes. And when it changes dramatically. And what we're seeing is that with a stronger dollar, with rates rising in the United States, we're seeing how money is coming back from emerging markets into the United States. And this is the economies like Argentina, like Brazil, and Turkey, which have increased their imbalances significantly in the last, especially in the last year and a half, and increasing indebtedness in dollars, are the ones that are suffering the most.
Is Turkey, isolated though in the sense of contagion, or might it actually contribute to some problems elsewhere in the world?
I think that Turkey has, quite differentiated factors, and the principal one is obviously that the growth in money supply has been phenomenal, and that the imbalances that the government allowed the economy to enter into were very large. But it's a symptom. It's a symptom of emerging markets that have accounted for almost 70% of the increase in dollar debt in the last years, and at the same time have not used this period of low interest rates and weak dollar to improve their economies. So I think that what we're seeing, is if you look at the list of those currencies that are suffering the most, the ones that are suffering the most are obviously the ones that have entered into largest imbalances in the last, especially 2 years, and the ones that are sort of maintaining a little bit of strength relative to the dollar are those that had, let's say, a tighter grip on fiscal and trade imbalances.
Daniel, let's shift away from FX, and I want to look at bonds because I've been looking at the moves in Italian yields today. Focus in on us for Italy and your expectation of whether this becomes something that is again isolated, or whether this could end up in some sort of contagion around Portugal and Spain once again.
So far, what we have seen is that the impact on Portugal and on Spain is very, very limited, because these countries have actually done their homework to a certain extent, reduced dramatically their deficits, made big reforms in their economies. However, all of this is disguised by the massive buying of the European Central Bank, which is more than the net issuances of the European countries in terms of bond issuances. So the risk that we have is that if the populist government grabs hold and starts to really push the limits in a sort of similar way to what Greece did a few years ago, it can create a ripple effect into other economies, because let's remember that all these economies have done quite well in the last 3 years. However, large public debt, large unemployment, there are strong challenges to these economies, and they have abandoned the reform agenda in order to allow the ECB to do all the homework in many of the cases. And I would say that the risks should not be underestimated, I have to say.
And there's much anticipation, there was hope maybe that the ECB would start to give forward guidance when they would start to end quantitative easing, end the bond buying and walk away from that sort of level of support. But when we have Germany's economy, the firepower of Europe slowing and seeing weakening growth as we did today with the PMIs, does that look ever more unlikely that we'll get that sort of forward guidance?
Yes, I believe that it is quite unlikely that the European Central Bank is going to add fuel to the fire by giving hawkish messages. I think that the European Central Bank is finding itself between a rock and a hard place in the sense that if it continues the quantitative easing, countries will further abandon their reform agendas that we were talking about before. But at the same time, if they stop it, it can create a much larger impact on bond yields, because we don't know what secondary demand there is in Europe for peripheral bonds when the European Central Bank, as I said before, is more than 100% of the demand for those issuances. So I think that it is very likely that given the fact that the PMIs for Europe, that the growth in Germany are showing very significant levels of weakness and definitely much worse than what consensus and the ECB expected, it is very unlikely that that Draghi will give hawkish messages, in my opinion.
Daniel, what about the US? We have the 10-year yield back to 3.01 now, close to breaking that 3% barrier again. How strong is the US economy, and will that feed through into inflation at some point?
I think that the U.S. economy is much stronger than the European or Japanese one. We have seen a weakening, definitely, of the economic surprise in the United States, but we have to take into account that it comes from a tremendously strong standpoint. So I think that the economy in the United States is much better prepared to see the rate hikes. Inflationary pressures are limited, not dramatic, and more importantly, I think that the indebtedness, for example, the S&P 500 has a much lower indebtedness than, for example, the Stoxx 600. And I think that what we are likely to see is data that, without being significantly stronger, supports a growth of 2.5% without a question, and continued reduction in unemployment. And obviously, as the unemployment figures go down, we also see that a wage pressure improves. Therefore, all of those factors will help the Fed take action.
All right. Our thanks to Daniel Lacalle. He is author of Escape from the Central Bank Trap and chief economist at Treasuries.